Let's talk more about this with Sarah Hewin, senior economist at Standard Chartered Bank. Good to see you, Sarah. It's that over-egging the pudding a bit by Vince Cable, that the problems in America are actually bigger than the crisis we're facing here.
I think it's Vince Cable's way of indicating that we shouldn't just focus on Europe, that we have to be concerned about what's happening in the US. To a certain extent, the euro area ministers have sorted out the immediate problem in Europe, and now it's up to Congress to do the same in the US.
And just how big a concern is it if a deal isn't reached, or even if a temporary deal is reached in America? Would that still have an impact on confidence here?
Well, it's very difficult to say, because what's been interesting is that so far the markets have given Congress the benefit of the doubt. There's been assumption that some sort of deal would be made, probably at the last minute. You know, if we get to that stage and nothing happens, then clearly there is going to be a loss of confidence. I think it just depends what the nature is of the impasse and how long it continues.
Well, let's take a look at more closely at what's happening on this side of the Atlantic. We've got GDP figures out for the UK, I think, tomorrow, isn't it? What are you expecting? Are you forecasting actually a contraction?
We're not forecasting a contraction, but it's quite a tough one to forecast. We have a huge range of forecasts, from negative growth down to up as far as 0.5% on the positive side. Our view is around about 0.3%. We may see something of an inventory lift for the past quarter, which might contribute to growth, but all the other components look likely to be pretty weak. In particular, consumer spending, government we expect will be weak. The trade side, that's an uncertainty. We may see some support from net exports.
Is this a little blip for the second quarter? Looking ahead, the third, fourth quarters are looking a little bit rosier, or is it pretty grim for the rest of the year?
Well, it looks a bit grim, I would have to say. If we take into account all the forward-looking data that we've seen recently, they're suggesting that the economy is going to be crawling along at between 0 and 0.5% quarterly growth rate. So very much below trend, and struggling really in the face of the fiscal contraction. The high energy prices obviously starting to fade now, so that potentially could be a boost. But there are a lot of severe headwinds for the UK economy.
What about Germany? What are we looking from them? Everybody is just looking at them and thinking, oh, please let that growth continue, because that's what we need for Europe.
Yes, and until recently we've seen the German economy performing very well. The IFO index that we saw last week was off its highs, but nevertheless it's still at a level which suggested a pretty robust rate of growth. Having said that, the other indicators are suggesting that in fact growth momentum is starting to slow, and that will come as no surprise given the global slowdown in manufacturing that we've seen. On the domestic side, though, the hope is that the drop in unemployment in the German economy should help to boost domestic demand.
We've concentrated so much on the bailout for Greece in particular, and we know that Germany is footing a great part of that bill. I'm just wondering whether it's possible to say how much impact the amount of money that Germany is putting out for the other countries is actually having domestically. Is that are you able to forecast that?
Well, I think the impact is more on the political front, because Germany is lending to Greece, and up until recently it's been lending at a very nice margin, thank you very much. So in terms of the impact on the economy, that shouldn't be negative. It's more of a concern for Merkel when it comes to the state elections, and we've seen that in the results.
Indeed. Sarah Hewin, really good to talk to you. Thanks very much for joining us on Bloomberg today.